All right, well, welcome to our town hall. It's hard to believe we are halfway through 2025. We're halfway through being a quarter of the way through the century. Go figure. I like to make this joke for the younger people. Who remembers Y2K? It's like, okay, sort of. Yeah. I wonder what 2300 will be like. Y3K?
We know the computers to work.
Yeah, they're gonna work too good. They're gonna work for you, or everyone on Neuralink just figured stuff out for them. But yeah, just crazy that we're a quarter of the way through the century. So this is gonna be open format for questions. Whoops. Basically, no questions off limits. If I can't answer it, then I won't, but you can ask it. So I'm gonna go over just kind of where we're at, the state of our company, and yeah, we do this once a quarter. Kind of open the company up for questions. All right, and then if you are online, you can drop them in the chat, and we'll keep them there as well. So you can interrupt me throughout if there's questions. I don't need to wait till the end at 50 questions. It's not working. Oh, because I think it's also focused now. Can you click back down to here? Yeah, perfect. Thank you. Yeah, that might be awkward. I don't know. Maybe you can look on your phone or something for questions. So we're going to go over performance, our vision, news and updates, goals, extracurriculars, and then Q&A. But of course, Q&A I'm going to take throughout. I think you stole my focus again. Oh well. So these were our goals for the second quarter. So we had a loan origination goal of 35 million, I believe we hit it. So that's good. We wanted to close 170 units, and we projected that we would have to qualify 275 units, which we projected we would have to quote 1,450 units. We wanted to raise the servicing portfolio to 82 million. We wanted to lift our AUM to 31 million. And then our investor capital managed, we wanted to lift that to 22 million. So these were our goals 90 days ago on this same call. What's up?
Our loan volume was 30 million and we got to 33.
Oh, that was our tier 2 goal. Yeah, 30 was our tier 1 goal, 35 was our tier 2
I think we got to like 33 though.
Yes, you're right. These are just our goals, recapping them. This is the actual. Does that look right?
Yes.
Pretty close to 33. And we've got a fancy chart, tells us how close we were. So we did our tier 1 goal, 30 million, so that's good. We were 6% shy of our tier 2 goal for loan volume. Closed loans, same thing, very close. Qualified loans, very close. Quoted loans, kind of similar story here. Active servicing portfolio, we ended the quarter pretty big, about 80 million, and I want to say we're over 400. So, the service team's very busy, managing a lot of inquiries, all things related to that, draws, extensions, forwarding, collections. Our AUM goal was 31 million, and we actually ended at 35. And then this number is not exact; it trails a little bit based on the most recent financials that we have available. So it's actually a little higher than this. So we hit our AUM goal, and then our investor capital managed goal, we were close. So we brought on a lot of private capital, and that means they're trusting all of us to do our jobs very well. So it's very, very important. And we had some of those investors here earlier in the year, so that was good. This is our track record as of June 30th. So as of the end of the second quarter, these are all loans that have completed their life cycle. So we measure loans. We basically believe that loans can end in 3 ways, which this is a little bit oversimplified. It's easier to track across multiple servicing companies and multiple trading partners. So we measure, did we get our principal back, which is green? did we do a short sale, which is yellow, then did we get a property back, which is red? And that's us or an investor that we may have sold the loan to. So aggregated across all partnerships. And so what you'll see here is we've actually improved a little bit. The short pays and REOs were about 2% this quarter, and now they're at 1.7. So we've had a few more payoffs and no foreclosures. So that's good. And this is over 926 completed units. Current portfolio, we've got 414 units in the Bridge portfolio. And again, this is as of the end of last month. This is the best it's been in a little while. A couple months, it's been flirting with 89, 90, 91%. Now we're at 92% current. So good loans. And what this allows us to do is it allows us to get a little more aggressive with our leverage. So that's kind of why we're not killing as many loans or we're not cutting back as many loans, is because I feel like with the performance here and with the performance here, we can afford to maybe make it a little bit easier on the sales team to convert, okay? But if we see issues, that means we're gonna have to tighten down, leverage, and it'll be harder on the sales team to convert. And so we're all kind of have to work together here. So green means they're current. The 60 plus maturity bucket is of course the worst bucket of all. There's 14 loans in that bucket. That's about 3.5%. So of these 14 loans, you got to figure not all of them are getting their money. Some will probably be REOs, some will probably be short sales. These other stress buckets aren't quite as significant. The 60-day lane probably is, but the 30 to 60-day lane, the 0 to 30-day lane, 0 to 30-day maturity, typically not as big of a deal. We obviously want everything to be current, but we live in the real world here. So what's interesting is as a loan gets in a further state of distress, the chance of it getting back on track, the odds of getting back on track actually go down. So if you're in the 0 to 30-day bucket, the odds of you going current are quite high. If you're in the 30 to 60-day bucket, your odds of going current lower. And then if you're in the 60 plus bucket, your odds are lower. So kind of the more it falls away from being current, the less the odds are that you become current. But this is good. This is the best the graph's been in a while. This is, of course, what we do here at Central Lending. I'm not sure exactly who's on the call, but there's a lot of private money in our space. We're not the only lender that lends to investors. We really pride ourselves on being reliable and being private. And we feel like those are key differentiators in a market that's crowded right now. Our market strategy is those 1 to 10 unit fix and flips and ground up construction, and we are really good at traditional housing. So where blue collar people would live, where it's a middle class neighborhood. We're not so much the best lender for luxury projects. We've done a few 7-figure loans here and there, but our average loan amount's $200,000. So our niche is that traditional housing model in the Southeast and Midwest. And the unique value proposition is, fast closings, easy process of things being in-house, and of course, the private money element that we don't have to, broker your deal out or whatever else. Do I have any questions? Can you check? Just in case. Just flag me down if I do.
Oh, we just got one.
What's up?
What's the difference between late and mature?
Servicing team's chuckling. So late means that we haven't hit the maturity date yet. So most of our loans go from 6 to 18 months. So in the event that, let's say you closed a loan in February and you are 60 days late, excuse me, let's say you closed the loan in March of 2025 and you haven't made your 5/1 payment, which would be your May 1st payment. On our end of June reporting, you would be 30 days late, 30 to 60, right? You'd be in the 30 to 60 bucket. Yeah. So if you owed for May 1st and you were in our 30 to 60 day bucket there, it's because you owed for May 1st, you didn't make your payment. So that's a June report, right? It's as of the end of the last quarter. Now, a loan that closed in March, if it's a 12-month loan, the money actually isn't due until March of 2026. So late loans are just late. Matured loans mean that short-term loan of 6, 9, 12, 15, or 18 months, if the money was due back to us and it wasn't paid back to us. So if it's a 1-year loan and the money hasn't been paid back to us in that 1 year, then it would be a matured loan. If it's matured and it's late, we give it the matured status as priority. So we treat it as matured. So let's say that same borrower gets caught up and then next year they don't sell the property or refinance, and the money's due in March of 2026. We're doing another one of these calls in July of 2026. Then he'd be in our matured 30 to 60 bucket. And the concern with the matured bucket is those are not extended, right? So we do try to extend with borrowers, provided that they're up to date on their taxes and their insurance, and we don't believe they need a subsequent extension. And they've been good at paying. Sometimes things happen. Property goes on the market, it needs longer than you think to sell it, whatever. So we do extensions. The maturity buckets have not been extended, right? And usually there's a reason for it. So that's why we pay particular attention to those. So matured loans mean they've run through that original term of 6 to 18 months, and late just means it hasn't been paid on time, but not yet matured. Yeah.
We have another question. So the matured bucket is worse than the late
Yes.
bucket, correct?
Yeah, I would say so. Mm-hmm. Yeah, the matured bucket is I'll go back to it actually. Yeah, this red bucket here of these 14 assets, we watch these very closely. You know, we're limited on what we can do about it, but we can make sure taxes and insurance are paid up. We can preserve the property. We can push the legal. You know, we try to see if there's multiple partners on the deal, talk to the other partners, that kind of stuff. Yeah.
To clarify further, late is the late monthly interest payment, matured is the principal balance.
Yeah, the balloon payments too, and that's the thing.
Yeah, there you go. Thank you. Said better by the services team. All right. Yeah, but I would say matured bucket is worse, but I would take a 0 to 30 matured over a 60-day late. Because a lot of times a deal matures, you know, July 1st, and it might be under contract to sell July 8th. It's not really as big of a deal. It's a week of default interest. Whereas if you have a loan that's 60 days late, like that's a significant problem, right? Something's going on there. So I would say if you were to look at the 60-day bucket here and the 60-day bucket here, you would say maturities are worse. I would take a recent maturity over a significantly delinquent loan. So, but yeah, getting into the weeds a little bit there, but overall, I'd say our performance is pretty good. And when you look at our resolutions, I think they're pretty strong. So I think we can afford to be a little more aggressive and kind of meet the market where the market is at. Also, our loss reserves are pretty healthy on each fund, and now we're getting a little granular, but we've got, you know, a 6-figure loss reserve on fund 1, and fund 3, the loss reserve is quickly climbing. So our loss reserves can cover what we anticipate for losses.
Okay.
Proven process. Of course, we look at your deal up front. We care a lot about qualifying your loan and having it fall through. So we try to not allow that to happen. And we believe that if you submit a loan with accurate data, meaning you told us your credit score, you told us your experience, and you told us if you had background issues, you told us a construction budget and ARV, right? These key metrics pencil out. We believe we are best in class at delivering the loan terms that you signed up for, okay? Now, where we run into issues is when these things change on us. But we believe that we are the best at delivering the loan that we've agreed to deliver if you supply the data if you supply the type of loan that you submitted. So we feel very strongly about upholding our side of that. And of course, our guarantee is that if you show us a term sheet, we're going to beat it. And it's very rare that we don't beat competing term sheets. We're in a growth mode. We're looking to capture more market share. And so we will do loans that aren't, we're not looking to hit a home run on every loan. So if you're a qualified borrower and you have a lot of options, we want to have an opportunity to work with you. So if you're getting terms that are maybe a little bit better elsewhere, we'd like to have a conversation with you. And I'll leave it at that. These are our core values. I believe very much in self-improvement, taking initiative, which is Act Now, success through innovation, which is all about using technology and improving relationships, and of course, ethics over everything. And we're going to expand on those, around our office and get posters up. And we got lunch. What's for lunch today, Jason?
Breakfast sandwiches.
Is it good? What is it?
It's a egg, cheese, and sausage from Good Morning America.
Yeah, so our coffee shop up front was Good Morning America for a little bit there, so that was cool. This is our 10-year target. So a lot of you are here. You kind of, I feel like we're reading the book Traction, and we're sort of building our company around that framework. And one thing that it mentions you should do is you should at least put pencil to paper and be disciplined about writing your vision down. So at least you give the people around you the opportunity to understand where the heck are we going? What are we doing here? And so this could change every 90 days. It could change yearly, but I like the picture. So we're looking to grow, right? So a 10-year target is an audacious goal, but it would be $1 billion in private capital managed. I would anticipate that we have more brick and mortar office locations like they're offering now. And I would anticipate that we have a fund of funds that can invest with other operators that align with our core values and strategies we're doing. Because it's very hard to put that much capital to work on an asset by asset basis, especially when the assets are 200,000 on top. So long goal, long horizon. But I figured I would at least share that with you guys. Where is the ship headed? And it might take a turn at some point, but this is kind of the direction we're headed. So we have rolled out LendingWise. We are trying to streamline submissions. And one of the cool features about LendingWise is each loan officer has their own submission link. So we don't have to play whose loan is it as much in the back office. We still do that a little bit. But every loan officer has their own submission link. So anytime a deal is submitted, it'll automatically go. You don't have to research who the customer is and kind of go through that. Easier submission for brokers to give their own information right on the initial submission. Borrowers now get it. Yeah, what's up?
So our distributions now depend on other operators?
No, at the 10-year goal. They're only depending on us. And I would say it's going to stay that way for at least 5 years. But if we had a fund of funds hypothetically at some point, then yes, it could get to that place.
That was the thought, though, not.
Yeah, exactly. It's not written into our current mandate, so it wouldn't even be possible with the current architecture. So we rolled out LendingWise, which allows for easier submission from brokers. Every borrower gets a automated email every day with a stipulation list of exactly what you need, exactly the stage it's in, and exactly why those documents have or have not been approved. So I understand that there's some issues with the software. There's some layout concerns that I have. There's some data entry redundancy that's frustrating, but at the end of the day, I'm not happy with the journey that our borrowers have from submission to close. And so I'm hoping that this improves that journey, but the job isn't done here. So there's still more things that we're going to work on. I'm even looking into developing our own borrower portal, but of course that's a whole nother project and then a lot of capital that would cost. So this is what we rolled out to help our borrowers have a more of a visual idea of where they're at in the loan journey. We've increased leverage 2.5% in the credit box, and that's across all those FICO bands. And the main reason for that is the performance. We just have not taken a lot of losses. The portfolio is very healthy, and so I don't want to beat the sales team over the head and be uncompetitive in the marketplace when we have a healthy loss reserve and our performance is very good. So we've decided to get a little bit more aggressive, and we're still not the most aggressive lender in the market. There's lenders offering 100% financing and 96% leverage and deferred payments and all this. We don't do any of that, but I felt that when you looked at our performance, you looked at the health of our loss reserve, the health of our balance sheet, I felt like we could make it a little bit easier on our sales team to win the right kind of deals. So we've increased leverage across all our FICO bands, 2.5% loan to cost. We've also simplified the leverage deductions. So if you're new to a market or you have a background or credit issue in your past, instead of having those measured in their own column on Monday, those are going to be worked into the exception decision at the end of the loan. So it doesn't mean we don't care about those things. It just means they're handled in one place. We are also rolling out standardized turn times. So there's a new column in Monday called I'm a smart guy. I don't know what it's called. It's called like, does your closing date make sense? And it's going to give you a no flag if it doesn't. It's going to give you a yes flag if it does. So basically, it's just going to check the stage of your loan. It's going to check the stage of your loan, the closing date. It's going to measure against today's date, and it controls for weekends. Doesn't control for holidays yet. That's coming. What's up?
It's work days until closing.
Work days until close. Well, no, but there's another one that tells you the
closing date check.
Yeah, closing date check. All right, thank you. So there's a column called closing date check, and it'll give you a pass or fail. So if it gives you a fail, it'll just signal you to, hey, go check your closing date. It's probably wrong. Or not wrong, but it's violating our rules. So we're making some type of exception to try and make that closing date. So hopefully it's just a signal that you need to update something. So I really want this to be streamlined. In fact, I want this kind of on our website, maybe on some posters or something, I don't know, but published to brokers. But I would like this to be kind of the standard. It's not to say if you're a VIP borrower and you need to close in 4 days, maybe, but we need to start with something in place where it's not just mad chaos all the time. And so I'm hoping that we can all agree on these turn times being expected and standard. And so basically all this means is if you have a lead or a canceled loan, we don't care what the closing date is. But once you move a deal into manager eval, your closing date should be at least 5 business days out and no more than 45 business days out. Okay, and once you move into pre-processing, which is that stage where we're paying for our evaluation, we can start working on a budget and kind of getting data entry together. We are no more, closing date is no less than 4 business days out and no more than 45 business days out. And once we are processing, if we're in the processing stage, we expect that closing date is no less than 2 business days out and no more than 30 business days out. If we're in underwriting, the closing date should be no less than 1 business day out and no more than 14 business days out. And if we're clear to close, we should be between 0 and 7 days out. And of course, we can revise this over time, but I felt like we needed a framework to operate within to at least start with something that's standardized. Now it's important that if you move a deal from processing to underwriting and it gets kicked back, your 2-day thing is still there. So you really want to move deals up, kind of not at the last minute, to sort of, if your closing is a week out, it's a first-time borrower and it maybe a deal that's got some hair on it, you really should get it into underwriting 3 days ahead of closing. That way we can kind of get comments back, get corrections made, because it's going to go from here back to here up to here. So so if it goes to processing and closing's 1 day out, sorry, if it goes underwriting and closing's 1 day out, it goes back to processing. Now I want that closing date to get pushed 2 days out. So that's going to be an issue for your file. Try to get ahead of it. So these are for RTL loans. I just do some logic-based stuff in for refinances. I'm seeing a lot of ground ups and additions, guys. If you don't have a permit, move it out 15 days past today. I mean, there's really no reason. These are for refinances only. So if it's a ground up refinance, if you're missing your building permit, you should move it out. You should really ask the borrower when are you expecting your building permit. They should give you a date. But if that doesn't happen, you're a couple weeks out. And then if you're missing evaluation or title work, you should be at least 10 business days out. These are ground ups and additions only and refinances only. But I'm seeing a lot of these kind of being scheduled for tomorrow, and then they get moved out 2 days, and then 2 days pass, they get moved out another 2 days. The issue with that is when we run our liquidity reports and we calculate the amount of capital we need to meet our needs, it really kind of messes us up when we think we're funding 8 or 9 million in a week, and we end up funding 4 million. So we really need to hone in our closing dates and really think about what is the most likely date this loan will actually close, and put meaningful thought into answering that question. The DSCR loans, you'll see the same kind of thing, but essentially there's just more time given here because these loans are more institutional, and we're bringing funding partners on for these loans. These aren't funded out of our debt funds, so we just need a little bit more time to get these across the finish line. For brokers, we've lowered origination fee on the broker channel only 0.5%. So this means a broker coming direct to us, retail, might get an origination fee of 1.5%. And as a broker submitting the exact same deal, it would be 1%. So you could add your 0.5% and be equal, or you could charge 1 point and be 0.5 point more, but maybe you provide the level of service that makes it worth it for them to pay you for services rendered. So we felt like brokers shouldn't pay equal to retail. So we've made our pricing more broker friendly. And so hopefully that'll get some good feedback. And we're also doing a daily deal room. So 90 minutes every day, we're on Google Meeting, talking with brokers about their scenario. So not only are we giving you better pricing, we're actually going through your exact scenario and giving it basically a soft approval on the fly. So we're going to make sure the deal's submitted, make sure it kind of fits what our for and making sure we can take care of you, and then answering any of your questions on the fly. So you don't have to call into an 800 number or submit a ticket or do anything like that. You can literally decision immediately and have any question you have answered on the fly. That's every day, 90 minutes. We also segregated the capital raising side of the business from the loan origination side of the business. So if you're a borrower borrowing money from us, you'll go to centrallending.com. And we felt like trying to mix capital raising with borrower activity was kind of confusing because there's an investor button, and who's an investor? Is that a limited partner? Is that a borrower buying rental properties? So we made a second web page, centrallendingcapital.com, just for our limited partners. So it's all about you guys. It's 100% focused on improving the experience our limited partners have. And should we announce the Agora thing? Yeah. So we're going to be transitioning over to a best-in-class software called Agora for just much more robust reporting. So I think you guys are going to be happy to see that. That's in the works. It'll be done in the next quarter. We're doing some capital raising webinars. Katie's doing No Investing Strategy Hour, and Heather's doing Alternative Assets Simplified. I like the green screen action there. Yeah. I'm excited about this one. So I'm going to be on there talking about deals. Maybe sell a loan on the show. I don't know. So it'll be cool. There's a link in the chat. Are we putting a link in the chat?
It's in there. Right
Oh,
now.
cool. All right. Cool. I'm excited for this one because I think we're gonna be looking at deals, why we funded it. If you want to buy a loan, you have like a live question on it. Like you can just buy a loan off our balance sheet on the meeting. I think it'll be fun. Or you can ask us those hard questions. Like, why did you fund someone with 630 credit? You know, we'll have to defend it, right? Maybe they had good experience. I don't know. So, but I'm excited for it. It'll be a good call. And even if you don't buy loans, but you're just curious about how that market works, it'll be a good thing to attend. Just got the bobblehead in from China, so that's good. We're bringing the 0% origination fee back, but to qualify, they have to take a selfie with my bobblehead and post it on Instagram. And it's only good for one loan. So the bobblehead's out front, but that promo is back, and I gotta say, I'm probably more excited about it than anything. But I think they nailed it. They got the wallet in the front pocket. They got the Apple Watch. So they got the golf shirt. And so I think they did a pretty good job. And they made the beard look better than it is. So, you know, it's not all grown up, but they really kind of did take care of it. So we got some new members for the team. So we are quickly growing. Everywhere. We got sales represented on here. We have processing represented on here. We have admin. No servicing. So we're going to need to add a servicing. So, and then our Q2 office champion by vote of your peers, and we're all excited about this one, is please. That's funny. I don't know what you get, but it's what do you get for this?
So he gets,
Wow.
you get parking up here,
There you go.
or for the quarter, or a gift card, which we can talk about, which we prefer. You also get 30 days worth of coffee at the coffee shop. And there's a plaque coming, which I think might be here today, that is also to be displayed at your desk, letting everybody know that you were the Q2 quarterly champion.
Yeah.
And just to say a word or two, we appreciate you in representing, our core values and your calm demeanor and, helping the team adapt to new innovations. So
Yeah, thank you,
appreciate
everyone.
Yeah. Absolutely. All right. Yeah, Tyler's been a tremendous help to kind of making all departments talk to each other and assisting with just all kinds of questions that people have. So appreciate that. All right, goals for the next year. These are our 2025 goals, but we reset them because we were halfway through the year now. So I think we could change them a little bit. Our loan volume goal, I think this one stayed the same though. This one we're on track. We have to keep climbing quarter over quarter, but we've got a chance at it. So our loan volume goal is 150 million. That hasn't changed since the start of the year. We think we can hit it this year, but it will require quarter over quarter growth. Closing units, we think we need to hit 723 units. We think we need to qualify 1,222 units, quoting 5,700 units. These have changed a little bit. Qualified has dropped a little bit because our pull-through rate has increased. Closing units, I believe that's decreased a little bit because our average loan has increased a little bit. And then quoted units has decreased significantly because we're not quoting as many in the system because of the sizer and so on and so forth. The active servicing portfolio, we have a goal of ending the year with about $100 million in the bridge portfolio. And that's, of course, across all loans in the family of funds and also loans that are sold with servicing retained. AUM, we have a goal of ending there at 46 million in AUM. And we have a goal of ending the year with $28 million in investor capital managed. So those are our 2025 year-end goals with a 6-month reset on some of them. What's Q1 results, Q2 results. So this is just showing our goals across what we've done so far for the year. So you can kind of see loan volume, about 28 million in Q1, 33 million in Q2. So if we keep climbing, we should have a shot at that. Closing units is climbing. Qualified units, interestingly enough, dropped. So our pull-through rate is increasing, which is good. It means our processing team isn't spinning their wheels as much on bad deals. Quoted loans is the same. So we closed way more with less qualified and the same quoted. So we're quoting better deals, I guess. The servicing portfolio grew about $8 million. AUM grew about 5 million, and then investor capital managed grew about 6 million. And AUM and investor capital managed aren't perfect for the close of the second quarter because these rely on the most recently finished financials. And of course, those are lagged anywhere from 30 to 60 days. So we do the best we can at the bottom too. Just a couple things I want to do for this year. I would like to get a permit approved to remodel the 3rd floor. Doesn't mean we're going to start construction, but I at least want to have a plan in place. So my office does not have a window. I like windows. I don't know, some of servicing, I don't think has a window. Yeah. So I think.
Yeah, I want a window.
No one has a window.
So really, processing has a good space, high ceilings and windows, and I go in there. I'm like, this is nice. But a lot of the other offices are a little bit, no windows. So if we can get that 3rd floor going, it would help out. I still want to improve our website, maybe custom build a portal or do something about our borrower journey. I think we're part of the way there, but we have a long way to go. I would like to come up with some type of loan committee or loan, I don't know, maybe loan committee, something that involves, a group or a set of rules that will approve loans, when I'm not available to approve them. We want to add another institutional investor to our strategy. We have great partnerships and a good track record with those partners. But I don't like all of our eggs being in one basket or two baskets. We've got great warehouse line and some buyers that buy a lot of loans off us. But it would be good to have multiple options just in case something happens with those relationships. And then we want to optimize our SaaS stack, spend a lot of money on technology every year and software. And sometimes we have 2 or 3 softwares that kind of do the same thing. So we're just continually looking at ways to optimize. The internal accountant also, I believe we've hired. So that person will start soon-ish.
Thursday.
So that's exciting. So that's good. That's another 1 year kind of rock off of our list. And we want to get our audit and taxes done before they're due. So this is a hot button with investors, as it should be, you know, getting those K1s to you early so that you can file your taxes on time. And getting the audits done early is that's tough. You know, it requires a lot of being proactive and being organized. So we want to have audit and taxes done. We really want to be kind of, we want to be very strong at that. So, all right, 90-day notes. I'm not going to spend too long on this, but this is for the next quarter. So 40 million is our goal for the next quarter. We think we need 200 units, 325 qualified, 1,450 quoted. We think we'll end the quarter about 90 million in the servicing portfolio, 41 million AUM, and about 24 million in investor capital. Oh, nice. Let's see the slide. So this is our office reward. If we hit our 40, that's not 40,000, 40 million. Too late. So we hit 40 million, our quarterly reward would be $1,000. If we hit 50 million, which is our tier 2 goal, it'd be $1,500. And we've hit it both quarters this year, so I'm hoping we can keep it going. I think it's a fair number that kind of makes sense with where we're at. I always wanted to get a little bit uncomfortable, but very doable. We're going to keep doing book club. So this is every Monday on our normal huddle. If you have a book that you've read that you think the team would benefit from, if you get up here and share it with us, we're giving you $100 to share your what you've learned from that book. I would like to see us relate the book to our work life. So I think that's one request I'm going to make is think about your daily work life at Central Lending, the book you read, and what are the takeaways that could improve that can improve your work life from that book. All right, that's it really. So is there any questions?
Just a congratulations, Tyler.
Yeah, Lawson says congratulations.
Thank you.
How am I doing on time?
Oh,
What's
we
up?
have a question.
Yeah.
Back to the plan to bring additional operators in 5 years. For me, this raises the risk profile tremendously.
Yeah.
Can you please provide more details on why you are doing this and how you are mitigating the risk?
Yeah, that's a good question. So, so let me go back to it. So this is a 10-year target. So this is, I just want to be very clear. This is not something that's this year, next year, 3 years out. This is what does Central Lending look like in 10 years? I think as we raise capital, as we raise capital, I anticipate that we will have a fund that's non-existent today. But I believe we will have a fund, and that fund's mandate is to invest in other funds. And those funds will be our funds that exist today and potentially other operators that do a similar strategy that we do. And yes, that would absolutely raise, whenever you bring in an outside operator, it absolutely increases risk. So you'd want to go to their office, visit their team, understand everything about them. But I would say if a fund of funds is not something you're comfortable with, don't invest in that fund. But of course, investing in a fund of funds has a ton of operator risk. So I would advise not investing if that's something that's of concern. I like it because it's an easy way to put a lot of capital to work. So as we scale, it would be very hard to, right now we have about $25 million. Let's just say we have $500 million. Well, to do $200,000 loans, it would be so many assets every day that like, we're still going to be more disconnected either way. Like we're going to have a bunch of different departments and offices, or we're going to be investing in other operators. So the bigger you get, you're going to have challenges with scale, no matter what your strategy is. So you're either going to scale with different departments and putting different people in charge, or using different operators. But yeah, certainly the bigger an operator is, the more you want to look at their checks and balances and how they're structured. Luckily for you guys, we're very small, so the quality of our assets are very good. And we care too much about every dollar that goes out, and so that's to your benefit.
So this won't affect the current fund?
Right, correct. Yeah, it's not allowed by the current mandate. So the only way it could is if we change the mandate, but that would require all the investors to sign off on the agreed mandate, or you'd have to be redeemed your capital. So, but I just want to be transparent on my vision, because the vision might not be, if there's a disconnect between the vision and kind of where you guys are at, but again, this is 10 years out. Yes, we're trying to grow, and this is the path forward that we see.
You see 3 brick and mortar locations. Do you have any ideas where those would be?
I mean, I don't know. They've thrown out Idaho. They've thrown out North Carolina. That's where Jason's at.
Hawaii.
No, not Hawaii. I don't think that's going to happen.
Arizona.
Well, interestingly enough, it's not on here, but one of our one-year goals is to get licensed in some of these difficult states to get licensed in. And I would like to get the lender's license in Arizona, but it requires a brick and mortar office there. So, but I think you just need one loan officer to be there. It's kind of not really that hard. So, yeah. All right, any other questions?
We have a comment.
What's the comment?
If your core values and core principles don't change for the additional operators, then nothing really changes.
Yeah, I would say scale is an issue no matter what, because you're just going to lose some quality control when you scale, no matter how you do it. And the question is, how do you mitigate it? Like, it's just common sense. If you're managing $1 million, you can literally watch every single penny. And if you're managing $100 million, it's harder to have the same controls in place over every penny. So now you're putting people in charge to watch those transactions. So as you scale, it gets harder to put the right checks and balances in place. And it's something that keeps us up at night. But we're going to do everything we can to keep the quality where it's at. So, but our quality now, I think, is very good. And so I'm proud of the track record we have. All right, that's it. All right, well, we're going to call it a session. We'll be back here in 3 months. So hopefully the third quarter is better than the second quarter. All right, thanks everybody for hopping on. Seriously, appreciate it.